Welcome to the deep dive. Today we're jumping into the world of global travel, taking a close look at, well, one of the real giants, Booking Holdings Inc. And we've got some really fresh source material here. Their Q3 2025 financial results. We're talking the full 10Q filing, the detailed report they give the SEC. It tells you way more than just a press release. So our mission today is really to get past those big, flashy growth numbers. We want to unpack the deeper structural changes going on inside Booking, stuff like big shifts in their business model, some major financial hits, and these huge regulatory pressures they're facing.
Yeah, that's absolutely right, because if you just skim the headlines, Q3 looks, frankly, fantastic. You see 8% growth in room nights, double-digit jumps in gross bookings, revenue. It looks great, but when you actually read the documents, you see a company making some really aggressive moves structurally. There's this huge impairment charge on Kayak we need to talk about, and they're spending a lot navigating regulations, especially over in Europe.
Okay, definitely lots to unpack there. Let's start with the basics, though. The core travel numbers for the quarter. How did they look? Well, the demand seems strong. Room nights hit 323 million. That's up 8% from last year.
Yeah, 8% is solid.
And total gross bookings were even stronger. $49.7 billion. That's a 14% jump. Revenue followed right along, $9.0 billion, up 13%. Big numbers.
Huge numbers. And you're right, it points to really healthy travel demand. We saw particular strength in Europe and Asia driving that. But, for listeners who follow this closely, we always have to talk about FX, right? Foreign currency exchange rates, they definitely played a role here.
Good point. So how much of that growth was like underlying business versus just favorable currency swings? Can you break that down?
Sure. So if you look at it on a constant currency basis,
Yeah.
basically taking out the FX noise to see the real operational performance,
Hmm?
the growth is a bit more moderate. Gross bookings grew 10% in constant currency, and revenue grew 8%. So you can see FX actually helped the reported numbers, particularly for bookings. It added about 4 percentage points to that reported growth figure.
Okay, so still decent growth, but the currency definitely flattered the results a bit. What about pricing? Were hotels getting more expensive?
Yeah, average daily rates, or ADRs for accommodation, they ticked up about 1% on a constant currency basis, mostly driven by higher prices in Europe. That was offset a little bit because they saw a higher mix of bookings from Asia, where ADRs tend to be lower.
Yeah.
But overall, prices edged up.
And the bottom line, how did that translate to profit?
Pretty well, actually. Net income was $2.7 billion. That's up 9%. And adjusted earnings per share came in really strong at $99.50. That's a 19% increase year over year. So financially, a solid quarter on the surface.
Okay, strong foundation then. But you mentioned these bigger structural shifts. This is where it gets really interesting, right? The move from the agency model to the merchant model. Yeah, the filings really spell this out. Booking.com is handling more and more of the transactions directly.
That's the core of it.
In Q3, the percentage of gross bookings done on a merchant basis hit 72%. That's up from 65% just the year before. That feels like a really significant jump in just 12 months.
Oh, it's huge. A 7 percentage point swing in a year for a company this size. That fundamentally changes the internal plumbing, and you see it directly in the revenue lines. Merchant revenue shot up 23.3% year over year. Meanwhile, their traditional agency revenues, where they just take a commission, actually fell by 6.7%.
Wow. So they are actively choosing to shrink one part of the business to grow the other?
Exactly. They're engineering this shift.
So what are the consequences of that for listeners trying to understand the business? Why make this shift if agency is simpler?
Well, simpler doesn't always mean better in the long run. In the merchant model, Booking controls the money flow. They collect from the customer, then pay the hotel later. But that means they have to eat the payment processing costs, they carry the working capital, and, critically, they bear the risk of fraud and chargebacks.
Okay. So more control, but also more cost and risk.
Precisely. And that's why you see expenses rising in areas like personnel and sales and other expenses in the 10Q. Those are things like payment fees. So this shift can actually pressure their operating margins even while revenue is climbing.
So they're potentially sacrificing some short-term margin percentage for what exactly? Why take that hit now, especially when investors can be so sensitive about margins?
It's a strategic bet. It ties directly into their whole connected trip idea. By handling the payment, they own more of the customer relationship. They can offer better loyalty programs, more payment options, collect richer data. It's all about making the platform stickier, encouraging direct bookings, and hopefully increasing the long-term value of each customer.
Okay, so it's an investment in customer loyalty and data, essentially.
Yeah, you could say that. If it works, the lifetime value gain should, in theory, outweigh the upfront costs and margin pinch from handling payments. And there's some evidence supporting it. Look at the mobile app figures they mentioned. Over the last year, the share of room nights booked via their app climbed into the mid-50s% range.
And that's good because...
Because app users tend to be more loyal, they use the merchant model more often, and crucially, they become cheaper to reach later on. You don't have to keep paying Google as much to reacquire them if they're already in your app. Marketing efficiency improves.
Got it. Okay, that makes sense strategically. But let's shift from that long-term plan to something that hit them right now. You mentioned a big financial bombshell, the impairment charge.
Yeah, this one definitely stood out. They recorded a non-cash impairment charge of $457 million in Q3.
Okay, first, what exactly is an impairment charge for folks who aren't accountants?
Right, so basically it's the company admitting that an asset they have listed on their books isn't worth as much as they thought it was. They have to write down the value. It's non-cash, meaning money didn't actually leave the bank account in Q3 because of this, but it's a formal recognition that the asset's future earning potential has decreased significantly. It's a big financial correction.
And the asset here was Kayak, their meta search brand.
That's right. The $457 million was split. About $180 million was against Kayak's goodwill. That's like the premium price they paid for Kayak's reputation and market position back when they bought it. And the other $277 million was against specific intangible assets, things like the Kayak brand name itself and agreements they had with suppliers. It's a sign that the value they expected from that acquisition just isn't materializing anymore.
Wow, nearly $500 million wiped off the value of Kayak. What reason did they give? Why is Kayak worth so much less now?
This is the crucial part. The 10Q explicitly states the driver was a reduction in Kayak's forecasted cash flows. And why were those cash flows reduced? Because of expected increases in customer acquisition costs.
Customer acquisition costs, meaning how much they have to pay to get people to visit Kayak in the first place, like paying Google.
Exactly. It's basically a nearly $500 million admission from Booking Holdings that the traditional meta-search model, which relies heavily on buying traffic from search engines and other platforms, is getting incredibly expensive, maybe unsustainably so.
So it's like an arms race for traffic, and Kayak is losing or at least finding it too expensive to compete effectively.
That seems to be the implication, yes. The cost of acquiring eyeballs is just soaring in the digital ad space, and it's directly hitting the profitability forecasts for that kind of meta search business.
Okay, so that's a huge external pressure hitting one part of the business, but you also mentioned they're attacking costs internally.
Right, it's like they're fighting battles on multiple fronts.
Yeah.
While they're taking this hit on Kayak due to external cost pressures, they're simultaneously running this big transformation program to cut internal costs.
The restructuring plan they started last year.
Yeah, that's the one. It's all about streamlining the organization, finding efficiencies. And they seem pretty serious about it. They actually raised their target for the annual savings they expect from this program. They're now aiming for $500 million to $550 million in annual run rate savings compared to their 2024 expenses. That's up from their previous guidance of $400 to $450 million.
So it's almost like they're trying to find savings internally to perfectly offset the kind of value destruction they just recognized with Kayak. $500 million hit, $500 million hoped for savings.
It does line up quite starkly, doesn't it? Of course, generating those savings isn't free either. They spent $105 million just in Q3 on the transformation program itself, mostly for severance packages and consultant fees. Restructuring costs money.
Man, these internal costs and asset write-downs are substantial. But then there are the external risks, the regulatory stuff. You mentioned Europe earlier. What's the big headline there from the 10Q?
Yeah, the regulatory environment, particularly in Europe, is a major factor. The biggest single item that jumps out on the balance sheet is a liability related to a fine from the CNMC, the competition authority in Spain.
Okay, what's that about?
It relates to investigations into their business practices, essentially competition law concerns. And the potential hit is massive. As of the end of Q3, the total recorded liability for this is over $900 million.
Yeah, $100 million.
Yeah.
Seriously.
Yep. It's split between current and long-term liabilities on their balance sheet.
Yeah.
Now, they're appealing it, and payment is suspended for now. But they have to account for the potential liability. It just shows you the kind of financial firepower regulators, especially in the EU, are willing to deploy against big tech companies they see as dominant players engaging in potentially anti-competitive behavior.
That's a staggering potential cost. And it's not just old fines, right? They're caught up in the new EU digital rules, too.
Absolutely. Because of their size and market position, Booking has been officially designated as a gatekeeper under the Digital Markets Act, the DMA, and also a very large online platform, or VLOP,
Yeah.
under the Digital Services Act, the DSA.
And those labels come with strings attached.
Oh, big time. They impose a whole raft of specific compliance obligations, restrictions on how they can operate, things their smaller competitors just don't face. It adds a constant, recurring layer of operational cost and complexity just to stay compliant in Europe.
Okay, so massive potential fines, ongoing compliance costs. Any other interesting legal or tax things resolved this quarter?
Yeah, a couple of smaller but still notable items. They finally settled a tax issue in Italy covering the years 2013 to 2018. That cost them an extra $23 million in Italian taxes.
Okay.
But interestingly, they managed to offset some of that pain with a $10 million tax benefit they recognized in the Netherlands related to the same years. So you see this constant push and pull of managing taxes across different countries.
Right, a global balancing act.
And then there was a significant positive development on the pension front in the Netherlands. There was this long-running dispute about whether booking employees should have been forced to join a specific industry pension fund way back to 1999. The Dutch Supreme Court finally ruled against mandating that retroactive participation. As a result, Booking got to reverse a big accrual they'd been holding for this, about $123 million, related to 2023 and earlier periods.
So a $123 million boost to the bottom line, essentially.
Well, it primarily helped offset their personnel expenses, which, as we discussed, are already under pressure from the merchant model shift and the restructuring costs. So that $123 million reversal provided some very timely relief on the expense side this year.
Okay, interesting how all these different pieces interact. Let's look forward a bit. How are they using their cash? Are they returning capital to shareholders? They seem to have plenty of it.
Yeah, their balance sheet is very strong. They ended Q3 with about $17.2 billion in cash and investments. And yes, they are definitely focused on capital returns. Back in Q1, the board approved a huge new share repurchase program up to $20 billion. Adding that to what was left from before, they still had authorization to buy back nearly $24 billion, 23.9 to be precise, worth of shares or reduce debt as of September 30th.
Wow, massive buyback potential. And dividends.
Yep, they also declared a quarterly cash dividend of $9.60 per share, which will be paid out in December. So they're using both buybacks and dividends to return cash.
So strong balance sheet, returning cash. What's the outlook? What did management guide for the end of the year, Q4?
They're expecting growth to moderate a bit, which is probably realistic given the macro environment. For Q4, they're guiding for room nights growth between 4% and 6%. And for the full year 2025, they expect gross bookings growth, on that constant currency basis we talked about, to land somewhere in the 8% to 9% range.
Okay, so still growing, but maybe not at those blistering Q3 rates?
Right. Management said they're pleased with the momentum, and they feel their global footprint helps them navigate any macroeconomic bumps in the road.
So bringing this all together, this deep dive really shows, like you said at the start, a company with two sides. There's this core engine at Booking.com that's still growing nicely and making this really fundamental, though complex, shift to the merchant model.
Exactly. That first giant is executing a necessary evolution. But then there's the second giant, wrestling with these legacy asset issues like the huge kayak write-down and facing these enormous external costs from regulation and competition. The merchant shift. Probably the right long-term move for controlling the customer journey. But that $457 million kayak impairment, that's a painful signal about a core strategic weakness. It screams that the old meta-search playbook is struggling badly against today's customer acquisition costs.
So the big takeaway seems to be that while the core platform is adapting and evolving, the battleground for attracting travelers online, especially through channels like metasearch, is becoming incredibly, maybe even prohibitively expensive.
Yeah, financially punishing, as you put it earlier. Which leads to maybe a provocative thought to leave listeners with.
Okay.
Given that the stated reason for the massive kayak impairment was rising customer acquisition costs, and also noting that Booking's press release made a point of mentioning their innovations in Gen AI.
Ah, interesting connection.
Right, so the question is, how fast could generative AI actually change the game in customer acquisition? Could AI help Booking create new, maybe more direct ways to attract travelers, bypassing the expensive channels like Google that are crippling models like kayaks? Could AI eventually make traditional meta search less relevant, or at least drastically change its value?
That's a fascinating question. Will AI be the solution to the very problem that just cost them $500 million on paper?
It's certainly a multi-billion-dollar question for them, especially as they decide how to deploy that huge buyback authorization.
Yeah.
Definitely something worth watching.